What is the total amount of money that you would be managing now?
Total assets would be between 10 and 12,000 crores depending upon where the markets wake up the next day.
So it's like close to 1.5, $1.6 billion. One of the key investments and the stock that you're invested in which made you good money was Page Industries. How did you identify that stock? What was your thesis which helped you in order to bet on that?
As a percentage to AUM, we were about 3% of our total corpus in one stock, which opened 15% below. And it had pricing power, it had reach, and more importantly, it had product, and it was getting market share.
Why do you always look for debt-free companies?
What happens when an industry doesn't do well is the industry profitability shrinks. When industry profitability shrinks, the company with the largest amount of debt has the biggest problem.
How important is a price earnings or a price to book multiple? What kind of weightage do you give to these metrics?
I mean, reasonably high, because at the end of the day, you're buying the denominator, right? And the earnings has to move to justify the numerator, which is the price. And if the price is going to move faster than the earnings, then you're buying too much of the future and the present. So let's assume the bond index is trading at 10%. Now I have to have an equity which is close to that bond yield that is sitting out there. We'll look at a consumer company, we'll arbitrage it against commodity business, or we'll take a bank and see whether there's more value to be generated. Our business is about buying capital efficiency at the price. Our business is not about buying banks, it's not about buying consumers, it's not about buying commodities.
How can one take contrarian bets or identify white spaces? वीडियो देखने से पहले मेरी एक रिक्वेस्ट है आप सबसे. मैं YouTube एनालिटिक्स देख रहा था एंड वहाँ पर देखा कि 82.6% ऑफ माई ऑडियंस हु इज वाचिंग दिस कंटेंट हैज नॉट सब्सक्राइब टू द चैनल. अगर मैंने आपको थोड़ी सी वैल्यू प्रोवाइड की होगी एंड आपको अगर कंटेंट बहुत अच्छा लग रहा है, आई रिक्वेस्ट ऑल ऑफ यू टू प्लीज हिट द सब्सक्राइब बटन सो दैट वी कैन ब्रिंग यू द बेस्ट क्वालिटी ऑफ गेस्ट एंड गिव यू द मैक्सिमम वैल्यू पॉसिबल. थैंक यू सो मच फॉर सब्सक्राइबिंग टू आवर चैनल एंड एंजॉय दिस एंटायर एपिसोड ऑफ Conversation with Kushal. Kenneth sir, welcome to Conversation with Kushal. Thank you so much for coming here. It's an absolute honor to host you.
Thank you for inviting me, Kushal. And firstly, call me Kenneth.
Okay, sure. So now you founded your own company, Oldbridge Capital Management. What is the total amount of money that you would be managing now?
So this is our 10th year in existence. We started off in 2016. 2015 is when the company actually got incorporated. Total assets would be about, we move between 10 and 12,000 crores depending upon where the markets wake up the next day.
Got it. So it's like close to 1.5, $1.6 billion.
Yes, a little less than that.
Got it. Fair. So let's talk about your journey of investing right from the beginning. And I want to take you back to your old childhood days as well. So I would want to take you to your childhood days and all. How did you enter the world of investing, and what was the time when you thought that this is something I would want to do it for the rest of my life?
I finished my graduation somewhere in 1989, right? And there wasn't much to do, and especially when you finish off with accounting and auditing as your majors, you end up trying to find a job with a chartered accountant firm, and things weren't as interesting as what I was reading till then. Okay, and what I was reading was every single publication that had to do with the business world and the capital market world. And fortunately, unfortunately, you also had the 1990 investing cycle that was there. So 1985 to 1990, we had a IPO bubble, so as to say. So what you're seeing right now, multiply that by almost 3x. And that was the quantum of stock that was getting issued out there. And it was interesting watching all of that happen. And I think that was the foundation years of what investing happened for me. So a lot of companies getting listed, you were browsing through virtually every company that was around, and there was enough documentation in most of the prospectuses about industries, about how they operate, about financial structures, equity raises, promoters, one promoter, multiple companies, everything that had to be there was there. It was the wild west. Okay. And I think that was the foundation years. So it's nice to be brought up during that period of time, because except for the 90s where everything went up, and then everything came down together, it was a decade of losing more money than ever than making it, and I think those are the foundation years of uh, of investing. What brought me into it? I didn't like accounting, and the only thing that only job that I got was with Capital Market. It was a magazine. Uh, uh, they Their specialty at that point in time was essentially IPOs and issuances, and they had a category of reporting that was called industry trends. So when an industry was doing well or when an industry was not doing well. Um, uh, these are the two parts of the magazine that I liked a lot, and that's how that's how I built up most of my databases or recollection of what happens in different industries at that point in time.
You also mentioned in previous interviews that you had always been lonely right from the start, and that helped you to spend more time with yourself. So this is something which was very interesting. So how has loneliness helped you in order to become a smart investor?
Well, I don't know about the question lonely, but yes, I've been a loner, right? And that comes. I always say, and I'm a Virgo, so I tend to look at a lot of Virgos around me, and they all end up being the same. Very hard to have a conversation with, and equally impossible for me to have a conversation with anybody. So that took me to reading, and I buried myself into everything that I could at that point in time. Right. So that was the limited thing about uh, gathering a lot of information. I wouldn't say knowledge, but gathering a lot of information. So being to yourself and being with a lot more books than you had people. I mean, you know what turns out after that, right? So you had a breadth of information, and that's about it, and that's what helped me in the as the career progressed.
Which are some of the books you started reading back in those days when you started investing? Do you remember?
It was I started largely fictional, then it went into business publications, and I used to read virtually every business publication out there and every financial magazine that existed at that point in time.
Got it.
So that used to be the core domain of what I used to do, what I used to read, and that continued well into the 90s.
So what was the time or what was the first taste of money success that you had and you were like, yeah, now this is something which I've made and now I'm going on the right track? Was there some turning point like that in your life?
No, I don't think money actually determined what I did.
Okay.
And I was a terrible investor. Okay, right through the 90s and even the early part of the 2000s, a terrible investor. But all of that helped in just one thing. Post the turn of the century, I just stopped making the same mistakes again and again. And I think that was one of the biggest lessons I learned. So money was never a motive. I think the largest pool of capital that I generated for myself was maybe around 2013, 2015 onwards. Before that, there was not much on the table.
Okay, got it. So let's divide our conversation into two parts. One is pre 2013-15, one is post 2013-15. So pre 2013-15, I want to touch upon two aspects. I also got to know, I think you had interviewed with Bharat Shah sir at Apple Mutual Fund like back in 90s.
So it was I had a job in Apple Asset Management Company, I think in 1993-94. That was the first round of private sector mutual funds that came through. Okay, so this was one of the many mutual funds, one of the 4 or one of the 5 mutual funds that actually came out at that point in time.
Right. So I had the honor and privilege to host Bharat Shah sir also 6 months back, and we discussed a lot about his reading habits and his investment philosophy. How were your interactions with him? And he's also been like one of the legendary fund managers of India. So what did you learn from him, and how was that entire stint for you?
It was very brief. I think it was just about 6 months.
Okay.
But I mean, I love people with a voracious appetite to read and digest information, and he was just one of them. I guess that's the thing I actually took away from my limited interaction of working with him.
Got it. And the second person you also speak highly about is a person named Mr. Vetri Subramanian. So how did you get a chance to work with him, and what were like some of the learnings from him? Just for people, so he's the current fund manager of UTI AMC, right?
Yeah, he's the CIO
Right,
of
CIO,
equities
right.
and UTI AMC. So Vetri onboarded me in Sharekhan. Okay, and I was struggling with my career in the 90s, and I got onboarded at Sharekhan. And I got onboarded in Sharekhan because they wanted a platform where someone could write. And I had a journalistic background, so I could write, and I also knew stocks. And I think uh, that's what changed. So from having a breadth of stocks, I think we were able to create a fairly decent product on the ground for investing, um, and built up a set of contributors to it who were analysts and also could write. And I think that's where we started off, and that's what Vetri onboarded me. And as time progressed, I think he gave me multiple chances to do what I do right now, including absorb me in Kotak and give me a product to manage. So he's been my mentor. He's been able to take most of the crude information that I had and productize it in that sense. And I think by far the biggest influence in my career. Vetri's been the biggest influence in my career.
Oh, wow. That's very lovely to hear. And then you worked at Kotak Mutual Fund for a period of 3 years.
3 years, yeah.
And then
Start of
it
5.
was IDFC.
Yes.
So, and can you tell like what was the AUM of IDFC and how it increased from the time you started and the time you left?
So it was actually Standard Chartered when it first started. And Standard Chartered started off with an equity. They were an all fixed income product. And they started with equity in, I think, 2005. And 2005 September, I joined them. So they had an average AUM of about 1100 or 1200 crores when I joined them.
And when you left them, you scaled it?
They were about 12,500 crores by the time I moved on.
Oh, wow. So almost like a 10 times jump in the AUM.
We did well. I say we did well in equities. But as a fund house also, it gave us a lot of freedom. Every individual out there got a lot of freedom to operate and create portfolios that they believed would do rationally well. So Standard Chartered helped me with the buy and hold structure. Not that I didn't know about it, but Kotak was 3 years, too short time a period to test the buy and hold structure. But Standard Chartered stroke IDFC helped me put those portfolios together. It also, a 10-year journey in IDFC also helped me put together multiple products. I mean, it started with a portfolio product structuring, and then I ended up being a CIO of that business, overlooking fixed income but not managing it, of course. But we took away a lot on the equity desk. We took away a lot from the fixed income part of ideation. So I think that's how IDFC worked for us. The fixed income product was very strong. The ideation was very strong. You utilized a lot of it and actually brought the team together.
And when you say fixed income product, what exactly do you mean by this product? What was this?
No, it was a bouquet of products that they had that every other fixed income fund house has. But the interaction between the fixed income and the equity business was, I would say, dramatically higher than any other institution out there. And plain examples of this is the fixed income team used to not buy a certain paper of a business. The equity team used to do exactly the same thing. So there was no conflict of interest between the two. And it didn't come because you didn't want a conflict. It just happened because the team actually directionally went in the same. We all directionally went in the same direction.
Got it.
So otherwise, usually fixed income buys paper of one company, and then the equity guy said, no, bad corporate governance, you're not going to touch that business. But one fund house can't have a different ethos in different asset classes, right? So that happens very normally in our industry. But this was one fund house that I worked in, uh, where, where discipline was reasonably very high.
Got it. And how did the entrepreneurial bug come into your mind, and how did you decide to quit your high-paying job to start something of your own?
Uh, I think it was largely accidental. I don't have an I don't think I have a bone of an entrepreneur in me right now. Okay, but it just happened by accident that I happened uh, to rather get exhausted with the system, which was trying to create more products than try to create an investment style or try to build an investment style. And that's where we stepped out, and that's where I stepped out. But incrementally, every time you went out for a job hunt, or when I was in that job hunt, the deliverables were still the same. I had to create number of products, had to create an institution back again, and it didn't, or in inverted commas, it didn't make any sense to me. So there's a colleague of mine says, like, start, see what you get, and then we'll see what the end product was. And I stepped out, and life's been good. Been lucky. It's been kind. Had some um, enormous learning experiences, but it's been good at the end of the coming close to the end of the 10th year.
Yeah. So let's decode all your learning experiences in the last 10-12 years of your own managing your own fund. So let's discuss this post 2013-15 journey in a manner where we can dive into your thesis on stocks and sectors as well. So I was just studying your portfolio companies, and one of the key investments and the stock that you're invested in which made you good money was Page Industries. So can you just help us understand how did you identify that stock? What was your thesis which helped you in order to bet on that?
Yeah. So that's a strange story. I wouldn't say strange story, but that is one of those businesses that did well, and very few of your listeners, or very few people in the industry actually know. If you pull up the Page Industries chart from the listing date, on the listing date, it was down 15%. Okay, and we were the largest shareholders in that business. So it was not very nice sitting in the seat I was at that point in time, because as a percentage to AUM, we were, I would say, that we were about 3% of our total corpus in one stock, which opened 15% below its IPO price. So that had a damaging impact on the overall NAV. But then things worked out right. But if I just step back and because I used to hit the road quite often just to explain what we're doing with companies and businesses, I think we just articulated the fact that, look, this is an unorganized business. This is a product out there, and it is a product which had a demographic pull. And it was aspirational in nature. Now, taking an innovator and making it aspirational, India's never experienced that before. Okay, and we are coming into that cycle of the next generation coming through. And it had pricing power, it had reach, and more importantly, it had product, and it was getting market share. Now you put these four things together, okay, any other business that you invest in or we invested in all followed the same pattern. As long as there was incremental market share, as long as the product remained aspirational and had pricing power, as long as the business didn't require external funding, which effectively meant it was cash flow generation, it was generating an enormous amount of cash flow, and slowly into a marketplace which was getting organized. Okay, I think once you captured some equation of these characteristics into a stock, it trended right. What I could not guess, and because the underlying bias has always been that you buy efficient capital at a price. Okay, efficient capital at a price. So if you're buying a business at 10 times price earning multiples, you're buying a 10% yield. Okay, if you're buying it at 15 times multiple, you're buying it at a 6.5-7% yield. right? And that's what I like about investing. You buy at efficient capital. But what I didn't count about is where it's trading right now, right? But that was the lucky part of it all. 15 times going to 20, going to 30 at a 3% free cash flow, let's still imagine. 30 going to 50, 50 going to 80 was something I never counted on. And that was my lucky part of my holding that stock.
So what do you mean by 30 to 50
30
to
times
80?
multiple, going
Okay.
to 50 times multiple, going to 80 times. Because this company traded at one point in time at 100 times earning multiple.
Okay. So 100 times the
Earnings of the business. Yeah.
Got it. And the industry average would be very low.
I mean, the rest of the industry followed, so everything else I didn't need to trade at 30 times earnings was also trading at 30 and 40 times earnings.
Got it. How important is a price earnings or a price to book multiple? How important is this ratio when it comes to investing? What kind of weightage do you give to these metrics?
I mean, reasonably high, because at the end of the day, you're buying the denominator, right? Which is buying the earnings, right? And the earnings has to move to justify the numerator, which is the price. Okay, and if the price is going to move faster than the earnings, then you're buying too much of the future into the present. Too much of the future into the present. Now, how many of us, not just around this table, but within the audience also, how many of us can predict the next 10 years of a life cycle of a business? So that's the problem. I find it very difficult to comprehend 2 years forward. Forget about 10 years forward. Okay, so I have the apprehension of disproportionately paying for an asset on the ground, a business on the ground. I'm not saying I'm right, but this is my style of investing. There are investors out there who could do it differently and are successful at it, but this is my style of investing. So a price earning multiple, in whatever context it is also the earnings that I have. I mean, it's also the earnings yield on what I'm paying for it. Okay, and it's very critical for me as to how much I'm very critical for me to know how much I'm paying at that point in time.
Fair. And are there any specific financial metrics and ratios that you also look for before deciding whether this company is worth investing in?
So we look for absolute value. Now we're talking about equities out here, right? So even a bond has a price earning multiple, right? And the bond price earning multiple of obviously the terminal value is the face value of the product. Okay, and that's where the terminal value of the equity, the stock price that you buy, is open for I won't say debate, but it's open. It's an open-ended question for different investors. Okay, and I think that's the big difference between a bond and an equity. For us, if I need to have a bias of buying a business, or when I'll repeat this. When I say that I buy capital efficiency at a price, it has to be at a price which is equivalent to my other asset classes that are available for me. So let's assume the bond index is trading at 10%. Okay, now I have to have an equity. I have to buy equity which is close to that bond index, bond yield that is sitting out there, close to it. And has an element of growth, because equities do have an element of growth because you have inflation actually built in. Okay, this could get a little complicated, but you can just intervene whenever you think you've lost me. Sure. But that's how we tend to look at it. So look at it from an absolute yield point of view. See what are the other instruments that are available. You will never see us saying that FMCG business, if you are buying you're buying this at 50 times earnings, 30 times earning in that index is cheap. You'll never see us do 30 times earnings is cheap, or 20 times for another company is cheap, or 10 times for another company is cheap. You'll never see us doing that. We'll look at a consumer company, we'll arbitrage it against a commodity business, or we'll take a bank and see whether there's more value to be generated. Our business is about buying capital efficiency at the price. Our business is not about buying banks. It's not about buying consumers. It's not about buying commodities.
Got it. When you said you will do an arbitrage against a commodity business, so what do you mean by this term? Can you explain with an example?
Um, so, um, uh, so, so if a steel business is trading is close to 2 year payback, which had happened at a point in time,
2 years
and
payback.
yeah, I
Okay.
mean, you had a lot of assets on the ground which are
Hmm.
available at 2 years payback, about 2018 and 2000. I mean, there was a power utility business which is at 3.5 years payback. A 3.5 years payback is almost 30% yield. Okay, and then the private sector banks and all the consumer businesses were at a 2% yield on equity. So what would I want to do? Okay, so you step back now and look in 2018, if you bought all the power utility companies and you sold all the consumer businesses which are not fashionable, and you fast forward to today. Okay, you step back to 2000 and look at all the IT businesses, and again look at all the commodity businesses, and then fast forward to 2004, 5, 6.
Hmm.
So when the narrative is very strong, when the consensus is very strong, you're making a mistake. And that's normally driven by um, where the businesses trade on a price earnings basis or price to earnings basis. So it's fairly critical how you how for us it's very critical how we use these ratios. Okay, we try not to make them convenient to our thing, to our investing style, and we're happy leaving a lot of money on the table for the next investor to come in. Okay, but we definitely want to be the first one in the cycle to own a lot of these companies.
So let's say if a young retail investor who's watching this and he is now analyzing a few companies and he wants to identify these arbitrage opportunities. So how can he, with the help of some examples or numbers, how can he identify, okay, this is the yield, this is the payback period here, and I should now invest in this business. So from a perspective of a young investor, how can they start doing these
You
things?
just avoid mispricing. See, there are two ways to invest. Okay, you eliminate a lot of businesses and you select a lot of businesses. Once you've been able to identify either of the two and what you're good at, I think your portfolio will get constructed.
Hmm.
Okay, a lot of investors come to me with the next best thing. They ask me about it. New generation businesses. I mean, the entire thing about what renewables that came up. The entire thing about these new generation. Uh, Sorry, I mentioned that new generation businesses, renewables, etc., electric vehicles, etc. But none of them throw out cash flows. How do you price this? You can't price them into the future, hoping things will happen.
Hmm.
Hope is it's a very bad investment strategy.
Yeah.
So for anyone who's watching this podcast, I'm not too sure um, whether my the principles of what we do echo with the next person, but just avoid mispricing. When you know it's wrong, it's okay. There's no harm in letting some part of the market go up without you participating in it. And this is something that I've learned. You can't be at all the happening parties at the same time. Okay, you got to stay with what your conviction is, and what you know is what you invest in. Okay, because what you invest in and you don't know when to sell.
Yeah. So I think we'll also come to that about when to sell. But before that, now, so we discussed about the Page Industries thesis. One of the other holdings is also MRF. So what's your thesis on MRF?
It's the same. I think when you look at us evolve, okay, as an organization, as an individual, there's one constant that we'll always be keep saying, right? Buy incremental market share.
Okay.
Okay, and the company has to have pricing power. And every one of these companies that you would continuously bring up in terms of discussion, whatever we have, they have these monopolistic characteristics or these dominating characteristics in their particular industry. So for them to be around for multiple generations or multiple decades with different management, the process itself gets them the market share. Okay, unless someone comes in and says this is not the way to work, then you'll have to be a little careful. But otherwise, it's in the DNA of a company or a DNA of a business to accumulate market share in a distressed environment. So if you look at, tires as an industry, cement as an industry, steel as an industry, in a distressed environment, the bigger get bigger. Or even in a consumer's business, or in an automotive business. And you have to consistently keep looking for that, and you will replay the same old stocks that you've been with before, because what you know before is what you keep repeating.
And how do you evaluate the management of the organization? How do you decide whether this is a management I would want to bet on? What are some qualitative factors you see?
It goes back to the same principles of investing, right? The principles of how you choose a company to invest in. Buy a large business who consistently on a down cycle gets more market share. For us, that comes from an investing process itself. Okay, take the worst company I won't say the worst company. Take the worst industry that is there. Capture the category leader who's doing everything right. Don't go by the hearsay. Don't go by the hearsay that this promoter is X, the promoter is Y. Because on a down cycle, all the entrepreneurs and all the promoters are crooks because the profitability is not growing. Right? So you take a cycle which is going down and just go back to the commodities business, right? It's a steel business. On the down cycle, every single entrepreneur, including India's largest group that is sitting out there, had capital misallocation. But when an industry doesn't generate profitability, it will look like capital misallocation. It was also to an extent, but when the industry is not generating profitability, it is capital misallocation. And then the capital misallocation feeds into the negativity of an industry coming down. And the reverse works on the way up. At the peak of the market, there are all the success stories that are being built out.
Yeah.
But there are no cash flows then.
Right. I think the importance of cash flows is quite significant when it comes to investing. If I just talk about the sector thesis as well. So I think about stocks, we're clear about the thesis that you have to buy companies which have incremental market share and a good pricing power. If I talk about the sectors, I would love to understand your thesis on the sectors that we'll discuss. One of the top sectors in your portfolio is pharmaceuticals. You had mentioned in one of the recent interviews. So what is the thesis behind pharma sector and how is that shaping along in the Indian economy?
So how much should I give out?
So as much as possible, sir. If you are comfortable.
Okay, so this makes it a little difficult to actually contextually talk about what our thought process is. But I think if you go through the portfolio components, every single business out there is doing something rational. Every single business is building on their core strength and dominance. And at the other end, I mean, if I'm not mistaken, a decade from today, some of these companies could get incrementally very large, and large to the extent of so it's a repeat of what I think has happened with IT between 2001 to 2010. The financials of the IT services business in the US companies became so terrible because they went through an entire M&A process, and they, apart from dealing with inflation and salaries, they had to service their debt because of the M&A process that was going on there. And you had very large IT services brands like IBM, EDS, and the likes of them who no longer exist today, or HP, who no longer exist today. And it was taken over by all the Indian companies, Indian services business. So the Indian services, IT services businesses at that point in time had cash on balance sheet. They have a cost arbitrage on manpower, and they were building up capabilities which are very much in line with what was required at that point in time. So they survived and they grew market share because they were in the market and they could expand it all. 2 decades forward, I think the Indian pharmaceutical companies are doing the same. They're taking advantage of all the M&As that took place at 2015, which was the first patent peak. They generated an enormous amount of cash on balance sheet. They built up capabilities. Each company has got their own business model today. And now you're coming towards another patent peak, which is 2029 to 2035. The size of that opportunity is almost 2x the size of that opportunity it was between 2011 to 2015. 2x and more. Okay, and an extremely profitable cycle. Of course, it comes through with challenges of competition and trade war escalations, etc. But I think we will be able to be in a very dominant position by the time that comes. So, at the outset, valuations are fair. Peak capex is behind them. A lot of R&D which has gone into their balance sheets have not been productive. When I say not been productive, this is for future reference. Future reference as in it has to come in future, and the market opportunity is growing at a or will be at a size that a lot of these companies and the industry has never seen before.
Okay. And is it also because of, like, let's say the black swan events like COVID, etc., that has also helped this industry?
No. It did help this industry in terms of generating profitability. So that one event helped a lot of companies clean up their balance sheets. So that definitely did help. But they've been a lot of them have had these one-time events for one particular drug that's coming. But this will be par for course over the course of the next 10 years. So some company or the other will have a new product which will demonstrate capabilities of generating large cash flows. It will be in patches, but it will be large cash flows.
Got it. Fair. The next sector is metals and commodities. I think this is also something which is major chunk of your portfolio. What's your thesis on this sector and how it has changed over the last few years?
Nothing really changed. We like the ability. So again, come back to the arbitrage in earnings that is there, one segment versus the other. So the absent. So 2023, 24, 24 mostly, and some part of 23 was very challenging in the sense that it was difficult to come past an opportunity which you could digest, saying that valuations were nice, or the risk reward is in the favor of the investors. It hasn't been for a while that the risk reward was in favor of the investor. So I think you have to work not just to buy a few subsets of the business where you could have a favorable risk reward, but you also have to avoid something which is completely which was completely priced in or more than priced in. So I think what we chose was businesses where the risk reward was in our favor from a valuation standpoint, from the scale of opportunity that is out there. Okay, so pharma comes there, metals comes there, and most of these companies have digested most of the capex. Their cash flows are at their all-time, are very close to their all-time high. Their debt is no longer a crisis that was there in the last decade, and most of the capex is now internally funded. They don't really need external funding that is there. So I think metals falls into that basket. So even without a price hike in any of their in the commodity, I think these companies will chug along at a yield of at a yield of about 4% to 5% at today's value. If commodity prices do well, obviously the return metrics could be significantly higher.
And when you say yield of 4-5%, so what exactly do you mean by that?
So they trade anywhere between 13 times earnings to 20 times earnings.
Okay, got it.
Okay, and this is when commodity as commodity have no pricing power today. So if you pictorially look at it, it's a business which is not doing very well. So commodity prices are down. Okay, and you're still getting a yield on the the company is still profitable. and cash flow positive and putting capex to work.
Got it. Fair. And agriculture sector, what about that?
We don't have too much of an exposure out there, though we used to. Though this has been one of my one of the categories that I used to like quite a bit. I still like them quite a bit, but they just went out of the pricing matrix. I mean, their companies are doing enormously well, huge cash flow generation, but it's right now it's at its minimalistic as far as our portfolio is concerned. We just got a seed company out there, but I think I waited fairly long for that company to actually on this one particular company.
Kaveri Seeds, right?
There's only one seed company which is listed in scale.
Yeah, I think I had read where I was just doing the research. So, any particular reason that you used to like this sector a lot and now you've reduced the exposure?
Oh, it goes back to the same thing. The industry was consolidating. It was dominated by public sector. Private sector was getting much more efficient. New capex was done all by private sector. They got cash flows. Post cash flows, they were trading at 3 or 4 times earnings. Regulated industry, nobody wanted to go there, and they've been reasonable compounders, if not significant compounders. Some of them have been large compounders.
Got it. And I've not seen you speak a lot about, let's say, banking and financial services and that sector. So, any specific thesis you have on BFSI as a space?
Well, it comes from two parts, right? So let me try and give my battle the cobwebs in my head in this one, right? See, we tend to be investors who like free cash flow. Okay, this is an industry that doesn't have any free cash flow, right? So it's difficult to figure out after a certain valuations point whether this business is attractive or not. Okay, this is the baggage that I carry. Okay, this is a specific baggage that I carry. Now, the converse of this is that any good business never trades very, very cheap. Okay, right now there are pockets of that environment that have started doing that, okay, which makes them attractive. So it's not that I have never invested in financials. Step back to 2011. We had all the NBFCs in one of the portfolios that we used to manage, and at that point in time, I think most of them traded between 0.7 time price to book to 1.3 time price to book, and then everything else happened. Okay, most of the consumer finance companies did extraordinarily well as interest rates continued to come down and as consumer lending picked up. Okay, so you own them at a point in time, but I've always had this problem of trying to define as to how much would you price them for you to have that safety net. So we were early in, early out. Okay, and right now we're in that entire phase. We're middling in this one. There's parts of the market which are reasonably cheap, or very cheap, should I say. It's interesting from a valuation standpoint. There will be growth in the marketplace. I don't think there's a structural problem out there. So we're watching that space.
But why do you say that this sector don't have free cash flows? Because let's say if a bank or an NBFC is there, the net interest margin would be their main source of income, which is the interest spread. And then of course there are other expenses which go out. But by free cash flow, from what I understand, is basically if you're generating operating free cash flows in the business, that is at least a good sign. So why can't it have free cash flows?
So one of the parameters that we use is the business has to be debt free. Okay. If you look at a balance sheet of a bank, it has to grow its balance sheet every year to be profitable. What is my ROCE metric? Okay, my ROCE or my ROE metric. Profit grows, balance sheet remains the same. Profit grows, balance sheet, my ROCE goes up, my ROE goes up.
Correct.
Right? There's another way. Profit remaining same. If I degrow my balance sheet, That means I either pay back debt or either do a buyback. Profit remaining same. My ROC and my ROE goes up.
Because ROE is calculated at profit
Equity.
upon net assets, profit upon equity, and you're saying that if the profit is same, if the debt is going down, the total assets which are there will automatically go down, and then the ROE will go up, right?
Perfect.
Okay.
You got that?
Yeah.
Now put that in context of a lending business. I won't say financial, a lending business, and that's where our disconnect is. That's why, like I said, it's something that I carry as baggage. So for me to initiate that trade, it has to come at a valuation which is reasonably attractive to very attractive. Okay, that's when I cap my downsides. Or that's when I have a significant margin of safety, which we always tend to look for.
Okay. And why do you always look for debt-free companies? Like even there are companies which have given good returns with debt by reducing their cost of capital. So what's the thesis there?
Okay, so if you build a cycle, or build an investment cycle that we use, right? And I said this sometime back, is like we try to buy the largest company in a industry which is not doing well. Now, if we try to do a small cap in an industry not do well, it's like catching a falling knife. And if that small cap has got debt in it, okay, what happens when an industry doesn't do well is the industry profitability shrinks. When industry profitability shrinks, the company with the largest amount of debt has the biggest problem.
Right.
Okay. So, I mean, go to the steel cycle or another sugar cycle, and I remember this one some time back, or even a construction cycle that is there. At times, it can be disastrous for any company having debt in a down cycle. And that's where we like to bring in a portfolio holding. So what consolidates a business? Shrinking profitability of the industry. Whatever profitability is there, the largest company has a dominant market share size of it all, and the rest of them are struggling with either the payment of debt, okay, which comes in because receivables increase. Any industry which is not doing well, inventories increase and receivables increase. So you can't escape a down cycle without these two factors that are there. The cost of doing business increases. So we tend to stay away from these kind of structures. Of course, when it reverses itself, then it's then everyone else does well.
So when an industry is not doing well, inventory increases because from what I understand, like sales are going down. So you have that inventory kept with you, which is the reason why it is going up. And receivables, why do they increase?
Yeah, I mean, it's a buyer's market.
Okay. So basically, this creates a cash flow problem then.
Yes, it creates a cash flow problem. And then that's how the industry consolidates.
Okay. Got it.
See, any industry moves from, every industry moves from oversupply, okay, from oversupply at the top, okay, to significant demand at the bottom. I won't say significant demand, but demand. And that's because supply comes off.
Sorry, I didn't understand this.
So every industry moves from fewer participants to a fragmented industry. Okay. So when you have when the profitability industry doesn't exist, you have 2 participants, 3 participants. Take aviation. Take telecom. Okay. When an industry has a 40% ROE, okay, everyone comes in. Take paints. They take FMCGs. Okay. So what attracts people into industries that are doing very well? So this is what happened. I mean, this is my interpretation of an industry that's doing very well. In an industry that does very well, it does a 30% ROE. Okay. So that industry participant is expanding capacity, right? Then you have newcomers that are there from other businesses also wanting to participate in that industry. Okay. He said if that industry is making 30% return on equity, my hurdle rate is 20%. Okay, then you have private equity comes in, they say my hurdle rate is 15%. And then the banks come in, banks' hurdle rate is 9%. So capital is available to create oversupply. So you'll come to this, what's our self-discipline? This is our self-discipline, right? So you could see it, stare it in your face. So what happened when one of the larger conglomerates announced its entry into cables? Okay, what happened? It's the same conglomerate who got into paints. Okay, we used to, in 2018, I think it was, we used to hold a lot of these digital broadband companies. And you had India's largest, one of India's largest groups get into broadband. So when you have hyper competitive, when you have an industry which goes hyper competitive, you lose pricing power. If you lose pricing power, you lose profitability. If you lose profitability, no market cap.
Yeah. Is it similar to this asset management company called Marathon Asset Management that also talks about a capital
They
cycle
have a framework
philosophy?
they have a framework that works almost identical.
Yeah, I think it's a UK based AMC, right? Got it. So what industry according to you now is not doing well?
I think plenty of them. You've seen some part of the lending space not doing well, which is basically
Okay.
microfinance.
Okay.
Okay. I think in pharmaceuticals, where Indian companies are consolidating the rest of the world, India's largest aviation company is in a very sweet spot. Okay, it's in a very sweet spot. Now you've got large execution risk with that business. I don't say it's value. I don't say it's in a very different part of the cycle. All right. I think commodities is the other one, or metals is the other one. So effectively, I'm rattling out my portfolio out here. But if you look at all of that, somewhere in the entire, somewhere out there is where we have our biases, and that's reflected in our portfolio. So our portfolio is all of 23 companies. Okay, and we squeezed it to as we try to buy probably the most efficient of the network out there.
Got
of
it.
each of those networks out there.
What would be your advice to a young retail investor? How many stocks he or she should hold at one point in time?
Oh, it's different for different people.
Okay.
I don't think anything, any investment style fits multiple number of people at the same time. So, at least in my peer group, there are investors who have done well with 50, 55 companies. There are investors who have done well with even larger amount of them. And if you step back to Peter Lynch, he virtually owned the entire marketplace, and he did extremely well.
So Peter Lynch, sorry, how many
he crossed 1,000 companies.
Oh, is it? Okay. And still one of the most successful.
Yes, at that point in time,
investors.
he was one of the most successful investors.
Got it. And IT, last one. So IT sector, that is also one of your favorite. So what's your thesis on that space right now?
I mean, it's dominated till today the services landscape. I expect it to do the same, but this time around it may not require the number of people that are there already on the bench to deliver those results. Okay, you will see a shrinkage, or you will see a slow growth in headline numbers, but you'll see a dramatically improvement in efficiencies out there.
Okay.
And that could come through automation of the entire space. But you can't wish away these companies. At least in the near term, I can't see anyone trying to wish away this space.
What has been your best and worst investment in terms of of course, in terms of percentage returns? What was your best and worst investment so far in life?
I can't say best or worst. I mean, there are a lot of worst investments that are there, or there's a learning curve that is there. But I think 2018 taught me something that uh, I knew but couldn't implement. We went out looking for value when there exists none. So very similar to what's happened over the last 6 months. You couldn't justify valuation. You couldn't justify valuations of what you were buying at that point in time, and it's a very similar thing happening today, or some part of the market today. You can't justify the price you're paying for some companies out there, and we did that in 2018. So from a portfolio standpoint, it was a flawed construct to some extent, but we were able to rectify that reasonably fast. When I say reasonably fast, and like in a year and a half, we had rectified the entire problem that was there. So that was a very brief period of my entire career where we actually underperformed the market, and quite dramatically at that point in time. Otherwise, I never had an instance where the market did remarkably better than where we were. So that's a fundamental problem of portfolio construction in that phase of time.
Got it. And you were able to deal with it and tackle that in a short span of time?
I wouldn't say short span of time, but yes, we've been able to overcome most of those hurdles around there.
How was your mindset like at that time?
Like everything else, like everyone else's, you were trying to live in the past. I should have done this. I should have done this. But that was not exactly what you had to do. But you could recalibrate it reasonably fast, or at least in the mind, you knew you had to correct it.
Got it. Fair. And in terms of your contrarian bets, also you're popularly called as one of the contrarian investors in India. So has there been like a contrarian bet that you took, and then after that you realized, this is something which went really right? Like everyone was saying something else, you said something else, and that played off really well. And which year was this? What was the bet?
I think it's the same period of time, 2018-19. We were all in manufacturing, utilities, and everything else. So we've got a clip up on YouTube on our channel, which the timestamp is 2020, and we talked about manufacturing in that period of time. Okay, it's still very relevant to see because what did we have as investors at that point in time? So we had as investors, we had enormous comfort level with valuations. I go back saying that we buy capital efficiency at a price. We had enormous amount of comfort on the price side. We had enormous amount of comfort on the capital efficiency price. We just didn't have the time. Okay, and in 18 months, we were back again. But 18 months is a very long period when everything is going wrong. So I think that's a period of time where, investing is all about having patience and is having patience with and having discipline and sticking to your style. Because if you've done it for a decade or 2 decades or 3 decades with the same style and you've always come back, I think it was a matter of time.
Investing is more of temperament and less of intelligence.
Perfect.
I think you would also mention this in one of the interviews. So if it's more of temperament and less of intelligence, how can one learn the habit of disciplined investing? Like the problem with youngsters is that we don't have a lot of patience and everyone wants to make quick money. How can one person, like one young investor, build the habit of disciplined investing?
I think you stay with the game, because when you're young and coming into the cycle, you have to see a couple of cycles before you become disciplined, because discipline doesn't come naturally unless you experience it by yourself. So I've got a team with an average age of, I would say, about currently 32-ish, 32, 33, and none of them has seen cycles as much as I have seen. So the only thing I keep telling them, and this is also for the viewers, I can get you the experience, you get me the stamina. I won't want to swap the two. Right? And they are my feet on the ground, but as long as they ask the right questions, they'll get the right answers. Okay, and as long as I ask them the right questions, I will get the right answers. So I have to put it together, and they will learn through that journey. I will be wrong. I won't be at all the happening parties. They will be right at points in time. But we can't make too many mistakes. Or we can't make any. I would like to say we can't make any mistake, but we can't make too many mistakes in our journey with fiduciary responsibility at this point in time.
Fair. And what about advice to a young investor who's figuring out whether to put money in stocks versus mutual funds? What would you advise that person in terms of what proportion to invest in which asset class? I know it's very person dependent, but
personal.
But let's say a young investor who's 25 like me and who is just on a salaried job in a city like Mumbai.
If you're doing it full time and have the patience to do it, if you're doing it full time and have the patience to do it, you can invest the time in picking stocks. But if you're doing to do it part time, you might as well give it to a professional investor, a bulk of your money, and use the balance to learn the ropes till you got enough experience to go by yourself.
Got fair. And just like lastly, in terms of the advantages that Indian economy also has over other economies, what would be your thesis on what exactly is the advantage or benefit that we as a nation will have over the counterparts?
I think we got the demographics. Look, we're 20% of the world population and 3% of the world GDP. Every other country is more balanced. That's our advantage. Now, how does that play out and what execution challenges we have? We all know them. But we've got to rebalance this GDP versus population bit. And that's why I'll invest in India. I mean, that's why India is such a big and large story that's out there. I mean, we are at $3,000 per capita income. Okay. So unless there's something radically different with investing or radically different that's going to happen in this cycle, wherein we continue to remain there. Okay, no other countries remain there. I think if you go back into history, Japan moved from a developing country to a developed country. Korea did that. The Far East tried to do it, couldn't succeed, and China did it. So that's our. I think that's our pitch. We are an economy which will move from a developing economy to a developed economy at the scale of population that is there.
And do you also have a specific thesis on the new age startups that are getting listed, like Zomato, etc.?
So we're cash flow investors, like I said. So we'll wait for cash flows to emerge from some of these companies and then buy them in the second cycle.
Okay.
We need to, I mean, everyone works with a total addressable market. I mean, that's fine. But if that total addressable market doesn't have profitability, we'll struggle. So we'll wait for this industry to finish one full cycle before we come back again. This industry has to consolidate. A lot of these companies out there have to consolidate.
Which one?
A lot of these companies out there, in their various formats, have to consolidate the market.
No, these companies, as in the new age startups.
New age startups have to consolidate.
Okay. And how can one identify white spaces? Like, in order to take a contrarian bet, you also, I feel that you also need to think in a different manner, which is the Peter Thiel framework also, which he asks everyone, what is one thing that very few people agree with you on? And for that, like, everyone has to be a very well-read person in order to identify the white spaces, etc. So how can one like take contrarian bets or identify white spaces if I am starting out investing? What is the process like? I know it comes with experience, but how can I also take contrarian bets in my life?
I mean, as long as you're not following consensus, you're taking a contrarian bet, right? Okay, and then go back to the format, and the way we do it is we buy earnings yield. It's as simple as that. So you use the price earning multiple of the largest company in an industry, and you'll be there. Okay, it's not very popular to follow that metric, to follow those directions, but just use a commonplace metric like this, and you'll be able to you will be able to get your results. See, there's a very common misconception, okay, that a company does well. Okay, a company does well on the upside if the industry's profitability is scaling. If the industry's profitability is shrinking, it's very unlikely that a company is going to grow profitability dramatically, right? We got that. So it's got to be a company and an industry. Okay, if profitability is scaling, every single company from the largest to the smallest, and the smallest will gain the fastest. But you've got to have visibility that the profitability of that business is increasing. The contrary is true. If an industry's profitability is collapsing, the smallest one dies out because it consolidates with the largest only. So a company and an industry go together. So if you have to be contrary, find an industry where the profitability is stagnant or falling. Stagnant, not falling, stagnant. Okay, and find a business which is consolidating the profitability of that space. Okay, you will be able to come out on the right side of that trade. It's not easy, but you need 1 or 2 businesses every 3 years, and that will determine your returns on the portfolio.
How many percentage of the times you have been right in your investing journey?
I don't count. Okay, but it's been successful. I mean, essentially, why you invited me here, right? I'm sure I must have done something right to be here. But yes, it's been a great journey. I can't say differently. We've been wrong also, but you have to be quick to realize that this trade is not going to work for you, even if you're selling it at the bottom or otherwise. If the trade is not going to work for you, you better parting ways with that business rather than spend too much of time in terms of over analyzing something that has been analyzed before.
Right. Any top 3 books that you recommend all the young investors out there, which taught you a lot of things as well?
So, if you take the 3 Fidelity Managers, I think it'll cover everything for you in terms of investing. It's covered everything for me, from Joel Tillinghast to Anthony Bolton to Peter Lynch. I think these are 3 investors who've written very different styles of investing, but these are 3 investors who put the products to the Magellan, the Special Situations Fund, and the low-priced equity stock fund. That was Joel Tillinghast.
Got it. Which one is your favorite book?
I don't have a preference in 3. I think as Fidelity has put this together. Of course, I have been through Marathon Asset Management. That's also a nice framework that gives you a framework to work in. These 3 are investing experiences.
And any specific resources in terms of newsletters or newspapers or something that you consume every day in order to stay updated?
I think it's generic news flow, and there are a lot of newsletters that are out there which are interesting and bits and pieces.
Like, can you give some examples?
I mean, regular news flows. We're fortunate to have the Bloomberg with us, so a lot of data comes through from there. And then obviously Howard Marks. It's a fairly well read piece of memo. He's got interesting thought processes that are there.
Actually, I just wanted to ask this since the start of the conversation. How are you so soft spoken and how's your voice so soothing?
I don't practice speaking.
So not even in your office?
Not too much.
Oh, okay. And are you also into meditation or some sort of
nothing.
Okay. God, because like whenever I interact with investors, I think one of the major activities or work is also to talk to management, promoters, their vendors, do the due diligence, talk to customers. So I've not seen a lot of investors not talking a lot in my experience. But again, as you're contrarian, like you're known for that.
Not necessarily.
This is
I mean,
different.
you have to come up with one question and let the guy answer for the next half an hour.
Okay. That's a good one. I'll follow this in my next podcast. But thank you so much for doing this. What do you think is one thing that we did not discuss today? This is a very open-ended question I ask all my guests towards the end.
No, I think you've been comprehensive enough for my journey as for my journey in 1985 till now. I think we covered most of everything that was out there.
Okay.
Yeah, probably you haven't asked me why we have only one fund which is there. Will you launch more funds out?
Oh yeah. So yeah, why do you have only one fund, and will you launch more funds in the future?
And I think we'll have capacity constraints in whatever we do, and there is an element of asset management in our business, and there's an element of asset collection in our business. I think I left the industry and because I didn't like the collection bit of it, because sometimes at points in time you get more money than you could manage, and it happened to us in the earlier part of our journey. So I'd like to keep it tight and like to keep it at 20 odd numbers of stocks per portfolio. So till this hits capacity, there will be no other product out there. Once this hits capacity, I have to find a colleague who has who can put together another investment thought process to build another portfolio. So no two portfolios from our end should look similar.
Got it. Any Indian investor that you admire a lot and who has been like your role model?
Naren's definitely out there. Okay, I think he's been able to put together portfolios for a very long period of time. And I think
yes. Of ICICI.
Yeah. Okay, and of course, Prashant's been an acquaintance, fellow portfolio manager.
Prashant
Jain.
And
been a long time. Yeah. And I mean, both the firms, Nalanda and Akash Prakash, and they put together very interesting portfolios and significantly ahead of the curve. Okay, so there are diaspora of investors. Not that the others are right. So you're making me choose people, but as portfolio managers, there are certain subset of individuals who put portfolios together very well. There are a subset of investors who buy stocks, and the portfolios get constructed around those stocks, and you can put those pieces together to see how they work.
Got it. Very, very interesting. But I think this was a very, very intellectual, very insightful conversation. I got to learn a lot from your framework and thesis. Thank you so much for sharing very openly about all the sector thesis, stock thesis, etc. I'm sure a lot of people are going to get a lot of value. So thank you so much for doing this.
Thank you for inviting me, Kushal.
Yeah, I hope I could do justice to your time as well.
Yes, you made me talk a lot.
अगर आपको ये वीडियो पसंद आया होगा तो आई रिक्वेस्ट यू टू शेयर इट विद ऑल योर फ्रेंड्स एंड सब्सक्राइब टू आवर चैनल सो दैट वी कैन गिव यू मोर वैल्यू एडिटिव कंटेंट इन द शॉर्टेस्ट अमाउंट ऑफ टाइम. हमको ये बताइए कि आपको कौन से काइंड ऑफ गेस्ट चाहिए, हमको ये बताइए कि कौन से क्वेश्चंस मुझे नहीं पूछने चाहिए थे, कौन से क्वेश्चंस मुझे और पूछने चाहिए थे ताकि आपको और ज्यादा वैल्यू मिल सके, और कौन से ऐसे पार्ट्स है जो आपको बिल्कुल पसंद नहीं आए ताकि हम लोग ये पार्ट स्ट्रीम कर सके फ्यूचर एपिसोड्स में. सो थैंक यू सो मच वंस अगेन फॉर वॉचिंग दिस एपिसोड एंड कीप शेयरिंग ऑल आवर एपिसोड्स विद योर फ्रेंड्स एंड कीप गिविंग अस फीडबैक so that we can improve and come up with better quality content.